Hello everyone, good afternoon and welcome to today's episode of Modesty's Money Masterclass. This is season 2, episode number 24. It's another Monday, another beautiful Monday for us all to come here and enjoy ourselves, educate ourselves and liberate ourselves through financial education. I hope you're all okay. I hope it's all going well. Even if it's not going well, there are so many more reasons to cheer up. There are so many more reasons to get yourself together and realize that this is another opportunity, a brand new day, a brand new opportunity, a brand new week, a brand new opportunity. Whatever has happened last week, in fact, whatever has happened yesterday belongs to yesterday. It's already in the past. So what we need to focus on now is what is ahead of us and what we need to achieve. So focusing on that, today we've got a very, very important topic that we're going to be talking about. Yes, a lot of you who might be listening to me may not be a couple. A lot of you might also be a couple. And when I talk about couple, I'm talking about couples who are in official kind of relationship, the statutory relationship or marital relationship or civic relationship. So today we're going to be talking about successful financial management for couples. What makes a couple's financial management successful? You know, in a family, in a unit, and what I'm talking about couples, a man and a woman. You know, you're living together, you're bound together by some kind of emotion, by some kind of relationship, and then you find yourself glued together. So you're glued together. Everything about you, about the both of you, is centered on making it work. So to make things work, you've got to make your finances work as well. And what we are here to discuss are some of those things that we need to know and some of those things that we need to do that will make those things work. Because the more of them we know, the more of it we do, the higher the chances of us succeeding in all that. So sit back, relax, and enjoy today's ride because it's gonna be a very, very interesting one. So it's a very sensitive topic today because whenever you talk about couples finance, I didn't want to call it family finances because once you talk about family finances, then you are extending it to the children, and to other elements and to other aspects of the family. But today I just want to focus on the couple, the man and the woman, the two central people in that relationship, because if the couple can get their finances together and be able to manage their individual differences financially, there is a greater chance of the family prospering financially. So that's why I'm focusing on the couple, on the two major drivers, the two major pilots of the family finances and how they can get their acts together and get their finances going. So I've broken this session into two different parts. The first part I have called for your information, which are things that I need you to have at the back of your mind, in your head, right, while we go on. And once you know these things, then we are going to come to the second unit where I have called it for your application, which means the practical things that you need to apply to make those things that you know work and to put them to work. Okay, so that's how I've structured today's session. It is for your information first of all, and then for your application. And I reckon I will not be able to do justice to this particular session if I treat every single thing that I have to talk about today. Is going to last us a whole day. And trust me, there are so many angles to couples financial management that it's impossible to do justice to it in just one session. So there's a possibility, and in fact there will be a part 2 of this next week, because I already have, for your information, there are 10 points that if I focus on those 10 points, it could take me the whole day. I could spend the whole session talking about that for your information. And then for your application, there are also 10 points that I need to highlight as well and explore and explain to you. So to do justice to this, we're going to take it half and half. So I'm going to take the first 5 for your information. I'm going to treat it today. I'm going to take the first 5 for your application, and then I'm going to treat it today. And then next week, we are going to finalize that and bring you the remaining part of today's session. Okay, let's dive straight into this. For your information, number one thing that I need you to have at the back of your mind and to know is that a couple is made up of two distinct individuals with differing financial views. A couple, say a husband and wife or a man and spouse, are made up of two different individuals, distinct individuals, and both of them have two different financial views. Not just two, but they have different financial views. So once you understand this, you will understand the importance of tolerance. You will understand the importance of understanding the differences, the individuality that exists between the two couples. Because first of all, what brought the couples together is emotional feeling, not financial issues. So what made you a couple in the first place is because you feel something for each other emotionally. And that emotional feeling was enough for the both of you to agree between yourselves that you are going to be, say, man and wife, or you're going to be civil partners. And then you came together based on that emotional feeling, and they started living together. That's the central focus. That's the central thing. Because you are not business partners. Even though somehow you might say you are business partners because you are in the business of marriage or you're in the business of relationship, fine. But you are not business partners. You are not financial partners. So it wasn't the financial consideration in the first place that brought the two couples together. It was the emotional attachment. It was the feeling you had for each other. And then alongside that feeling, you came together and then you had to manage each other's financial differences. Because you want to make the relationship work. And to make that relationship work, the finance became part of it. So every party in that relationship came with their different financial views. So you cannot come with your own financial view and impose it on the other person. The other person cannot bring their financial views and impose them on this other person. So if you understand that first of all, you are two emotional individuals brought together by emotional attachment, that you are not business partners, you were not initially financial partners, you were just brought together by emotion, and finance became part of the work that you had to do to make that relationship work. So when you understand this, and put it at the forefront of whatever decisions you're going to be making, it makes it easier for you to understand each other's differences. That is number one. Number two thing that I need you to have at the back of your mind is that it might be impossible for the lifetime of that relationship for you both to be able to align your different financial views and bring them together. Okay? It might be impossible. I am not saying it's possible that for as long as the both of you live together, your financial views may never be aligned to each other's. It may continue to be different for as long as both of you live. So it is possible, and there's nothing wrong with it. Yeah? But let me just break this down a little bit. What I mean by this is, for example, I'm going to give you an example. I was talking to someone, a man who has a wife and children. He's doing very well financially. So we were talking about savings and how savings are very important for family finances and for individual finances. So this guy called me up from Nigeria and he said, boy, let's talk about it. You've been preaching about savings, and I just wanted to talk to you about, because I have different, my views as per this savings thing is different. I said, okay, share your views with me. He said, I don't believe in savings. I believe more in investments than savings. Because I think whatever money I want to save, I would rather invest it, make more money, and then solve my problem from the income from that investment that I've made, and that takes care of me. So his idea of financial security is is based on investments and not savings. So he feels that the more investments he makes, the more income he generates, and the more financially secure he is. And he said, there is nothing I have wanted to do that I've lacked money to do, because my investments are yielding me income. So why should I save? So I believe more in investment than savings. But he admitted that his wife is the opposite. His wife believes in savings. And his wife still believes that no matter how rich they are, that they should still be saving some money just for the rainy day. But he thinks that he's financially secure, his investments have covered the rainy day, and he admitted to me that there has been times when the investments he has made has failed, and they have not yielded him the right amount of money, and then he's lucky to bounce back again in investments. So mark that word, lucky. So what I'm saying here is, you can see that in this relationship there are two different views. We had a very long conversation about savings and this, and I tried to differentiate savings from investments for him, to make him understand that you cannot say that you have no reason to save, right? Because emergencies do happen, and when you save, what you're doing is that you're protecting your investments. Because what it then means is that whatever income you're generating from that investment, you can then reinvest it without actually dipping hands into that and spending. But if you have savings and you have emergencies that you have to spend from your savings, you dip hands in your savings and solve the emergencies, so that you don't touch your investments, and your investment will continue to thrive outside of your interference. So we had that conversation. It was obvious that he had this strong feeling and this strong belief about investments over savings, but his wife has a different view. So you can see in this instance, it's possible that for as long as they live together, it doesn't affect their relationship, but their views financially are very, very different. And as long as they understand that, they can carry on doing what they are doing. Oh, wife, if you make your money, when you get money, save. I'm not against you saying, please save. It's for the benefit of all of us. For me, I'm going to focus on investments, and I'm going to continue to invest. I'm not saving anything. You can save for all you want, but I'm not saving. I'm just keeping it. And the both of them will carry on living. But those financial views that they have may never be realigned. They may never come to agree on it for a lifetime, and it's very, very possible. That's number two. Number three thing that I need you to also have at the back of your mind here is that understanding each other's financial strength and weaknesses is very crucial to the couple's successful financial management. Every couple have their financial strengths and weaknesses. There are areas of finances that one person is good at and the other person is better at. So if you understand where this person is stronger and where this other person is weaker, it is very crucial to the successful management of your finances as a couple. For example, one couple might be, the expert hunter. He's the one she's the one who's skilled enough to make enough money for the couple, for the household. Then the other couple might be more into financial management and more financially savvy to be able to allocate that income coming in for the both of them to the rightful places. Oh, how much should we save? How much should we invest? How much should we, allocate to charity? How much should we give out to extended families and all that? Making sure that the family is always financially afloat. So for one person, their skill or their strength might be in financial savviness, making sure we don't overspend. When it's time to shop, they are the ones handling the shopping because they can price, they can haggle, they can negotiate, they know where to get the best deals, they will know how to make sure they don't waste the money that they're coming in, while the other person will focus on making the money, and the person making the money might not be so skilled at financial management in terms of being financially savvy. He might not even know how much they are making. Some couples, some of them don't even know how much their household income is. It will take the one who is financially switched on to now sit down and say, okay, this is how much has been brought into into our coffers, this is how much we have, and this is how much we have to spend, this is how much the expenses are. That one is more skilled in budgeting. So you need to understand each other's strength and each other's weaknesses. Where this one is stronger, you allow them deal with that side of their strength. And where this one is weaker, the stronger one will support. So if you find that one party is not financially savvy, that they spend too much and they spend a lot, you can step in and try to guide and try to help, even if it means helping them. Say, okay, you spend too much, okay, let me handle your account. From now on, I will have access to your account, and let's create a separate account for you where once you get this money in, we're going to transfer the money you need for the week or for the month into your separate account. Leave this one for me, I'm going to take care of it. You work together on that. So understanding each other's financial strength and weakness is very crucial to the successful financial management of the couple. That's number 3. Number 4 thing that you need to know is that financial transparency, right, is the ideal status in the relationship, but it is not always the realistic one. Okay? Financial transparency is the ideal status in a relationship, but it's not always realistic. Financial transparency means everybody is open to everybody. You know, the man is open to the woman is open to the man. This is how much I earn, this is my pay slip, these are my bank statements, this is my insurance, these are my investments, this is everything concerning me. This is me. My financial book is open. So I know everything about you financially, what's coming in and what's going out. You know everything about me financially, what's coming in and what's going out. It is the ideal thing, but it is not always realistic. Get that at the back of your mind, right? Because the earlier you know that, the better you learn how to manage it. The ideal thing is for couples to be financial. No, every couple wants to know what the other person is doing, to be sure that they are all on the same page and on the same goal. That's ideal. No couple wants one of them to die and then the other one will be struggling. You know, where is his money? Where is her money? You know, if one of you loses each other and then the other person is alive but struggling to bring your finances together, that's not the ideal situation. But the realistic situation, the reality is that it is not always the case. There are still couples who do not know what the left is doing from the right. There are still couples who are not financially transparent. There are still couples up to date who believe that their spouses do not need to know everything concerning them financially. Or there must be that little thing you keep for yourself. Don't expose everything to them. That's the reality. So we need to deal with that reality. We need to understand that it is a reality that some couples will never be open. Even if they are dying, even on their dying bed, they will still not tell their couples where they have kept their money. Well, some on their dying bed they might, but you might not have the grace of being on a dying bed. You might just die in a motor accident. It's possible. You might just die a sudden death. You might just develop heart attack and then that's it. You know, you might not have the opportunity of saying, okay, not everybody has that grace of their family surrounding them. You know, and their final days here on earth being counted down. No. It might be so sudden that you don't have time to put your house in order. Okay, so the reality is that some couples are not transparent, but the ideal situation is that couples will be transparent to each other. Understand both differences and then you know how to manage it. Number 5 thing, and the final one I want to talk about today, about for your information, is that financial management that is based on self-sufficiency is most sustainable than the one that is third-party dependent. Financial management that is based on self-sufficiency is more sustainable than the one that is based on third-party dependent. If, as a couple, you are dependent on third party to get your financial lives and your lifestyle going, it's not sustainable. For example, your in-law, maybe one of the parties have a rich in-law, and that rich in-law always props up your finances all the time. It's not a sustainable financial model for couple, and it will not contribute to a successful financial management. Because that third party you're depending on, for example, your in-laws, they can decide to switch off the tap anytime. And if they switch off the tap, that's money coming from there is gone. So you cannot count that as your income as a couple. So a couple that is focused on their self-sufficiency, whatever we make between ourselves, this is what is sustainable. Let us budget and structure our lifestyles according to what we have within our coffers, our household. That sort of lifestyle, that sort of financial management model is more sustainable than the one that is dependent on third party. So if you're a couple and you're drawing your budget, and in your budget you're including gift from parents, or gift from brother, gift from sister, gift from brother-in-law, and that's no, that's not a sustainable way of managing a couple's finances. It has to be based on self-sufficiency, because that is the one that is sustainable, and that is the one that you can count on. Okay? So let's go into the practical side of things now. I'm going to give you the first 5 for your application points. Right? Remember, next week when we come back, we're going to finish the remaining 5 for your information. We're going to again finish the remaining 5 for your application. So for your application, number 1, maximize the income potential that is between you as a couple by allowing each party to be economically contributing. If you are a couple, what it means is that there are 2 potential viable economic units in that household, in that relationship. Maximize those 2 potentially economic viable units by ensuring that each of you are contributing economically to the household. It's very, very important, because if only one person is contributing economically, it's almost like an aeroplane that has 2 engines but it's running on one. Yeah? It's almost like an aeroplane that has 2 engines, and when an aeroplane is running on one engine, it affects the efficiency, it affects the speed, it affects even the safety of that aeroplane is compromised because it's running on one engine. So your financial safety as a couple is compromised if only one person out of the 2 is economically viable. If anything happens to that one unit that is economically viable, the whole party is affected. So it's important that the both of you maximize the economic potentials between you, because you work best when you work together. When every one of you is contributing financially and economically, it makes things a lot easier. You know, it's possible that, you are earning more than enough for the other party to sit home and yes, that's fine, it's up to you. But all I'm saying is that there are 2 potentially economic, no matter how little one is contributing, it makes it, and not just for the financial reasons, for the psychological reasons, for the emotional reasons. When you see a couple where both couples are financially contributing, there is so much confidence in both of them. It helps the self-confidence and the self-esteem of each party, because there is nothing as fulfilling as knowing that you are earning money and you have the capability and the capacity to earn money, and even if you're not looking after the whole family, you're looking after yourself. It's so fulfilling. So that's number 1 for your application. It helps the financial management. It helps the financial oil. It helps oil the financial wheel of the family efficiently. Number 2 for your application is to split your financial management roles according to your strength. Split your financial management roles according to your strength. Remember what I said when I was talking about, for your information, that there are 2 different individuals with different strengths and weaknesses. So identify what your strengths are and split your roles according to your strengths when you identify them. So when you identify who is stronger in budgeting, let that person deal with the budgeting side of things. When you identify who is a stronger negotiator, and there are things and purchases to be made and shopping to be done, let the stronger negotiator go out there and purchase whatever you need to purchase. Negotiate whatever you need to negotiate, right? And when one is stronger in, being more financially savvy, let that person be the one managing the financial expenditures of the family. And then the one who is stronger in going out there to earn money, make sure you support them as much as they can. Even if it means, oh, go out there, do your stuff, come back, food is ready. Yeah? That's a way of supporting. Or go out there, do what you can, come back here, and I will make sure that the money is well spent. That's the way you support. So focus on the strength of each other and split your roles, your financial management roles according to that. If you need to do insurance, and this person doesn't know much about financial services, whoever has more knowledge about financial services should take up that role and arrange the insurance for every one of you. If you need to open a bank account and this person doesn't know much about which bank account offers more benefits, let the one who has a better understanding of how bank accounts work deal with that. Simple things like that are things that work. If you need to open an investment account and this person doesn't know much about how investment accounts works, let the one who has better knowledge open that investment account and both of you can now invest in it. That's what I mean by splitting your roles according to your financial strength. Number 3, be open and transparent about your finances and your financial plans. I have said before that financial transparency is ideal, but it's not always realistic. So ideally, be open and transparent about your finances, because the more your partner knows about your finances, the better it is for them to help you manage it, for them to identify whether things are going wrong. I've seen a couple where one of them was into gambling and the other person didn't know. And the only time they found out was when they wanted to do a mortgage. And they came to me and I got the bank statement of one of the partners, and I said, look, your partner is into gambling and the bank will not accept this bank statement for mortgage. And the other one was screaming and said, I never. That's what financial transparency does. If you know what your partner is doing, then you can help out where you need to help out. If the person has a gambling problem, then the other party can help them get through that gambling problem and help them manage their finances better. And it helps. Be transparent and be open financially. Number 4, be mindful of the implications of financial association with your partner and ensure that every party is comfortable with that. If you live in the UK here, your credit report, if you're married and you have a joint account or joint mortgage with your partner, you're financially associated. What it means is that whatever one party does affects the other. So be mindful of that and make sure that every party is on the same page and you understand the implication. So even before you go into financial association, you want to have a joint bank account or joint loan or joint mortgage, anything that joins you together, understand the implication. Make sure you're comfortable with that. Make sure that you know that if it affects one person, it's affecting the other. If this person has a poor credit, it's going to affect the other person's credit report or credit status. As long as you have that understanding and both of you know the implication and you're happy to go ahead with that, go ahead with that. But understand the implications first. Number 5, finally, is to establish your joint financial goals together and work out ways to achieve them. Your joint financial goals, in as much as you have your personal financial goals, establish your joint financial goals together and work out ways between yourselves to help achieve it. Because if both of you are doing 2 different things and you don't have joint financial goals, you're going to be going in 2 different directions. There is no meeting points, and then there will be anarchy and there will be chaos. By the time this person finds out what this other person is doing, it becomes chaotic. So when you have a joint financial goal, both of you will have to decide what your joint financial goals are, and then both of you have to work out how best to make that work. So thank you very much for being with us today, and I'm going to be with you again next week, same time, same station, same channel. And please like and subscribe to our YouTube channel, because we're uploading all our videos on YouTube as well. Search out Modesty's Money Masterclass on YouTube,